Welcome to your weekly market update. We've seen mortgage bonds remain very volatile. If you look at our charts, we locked in interest rates here. The Bank of England surprised everyone. They were expecting to raise their interest rates 0.25%. They went 0.5%. That caused some concerns for the global market. And a couple Fed members came out in the press, said, hey, we're not done raising rates. So just more uncertainty in our markets of what their future is going to be. We've had a nice rally, however, and you can see this trend line right here has been our friend. So mortgage bonds are starting to trade in this tight range. Usually when you see that, they'll bust out one direction or another. We're going to need a really good July CPI number, which comes out, or June CPI number that comes out around mid-July. We've seen some continued strength in the housing market when it comes to appreciation. So I continue to share these charts with you just to prove that housing remains a good investment. Case-Shiller, which measures mortgages above the conforming loan limit, so in most cases $726,000 and above, and cash offers, you can see month over month we're up 0.5%. So think $1 million homes, that's up $50,000. So that's a lot of money. When we look at it from that perspective, year over year, it is still down slightly. The pace for this year is 3%. Now, remember, we were at the very peak last year in June 2022. So to only be down 1.8% for the peak, it looks like we're working back up to that all-time peak in home values on the more luxury market. FHFA, which measures conforming loan limits, and both of these reports are our go-to. They're very well done. They don't have the big adjusters of all the federal inputs when it comes to the government running these reports. So we lean on these reports. But FHFA, which is think of loans or think of homes between 100,000 and probably around 800,000, was up 0.7%. That's 3.1% for the year. That's above the peak of 2022. So when we're looking at, I would call them mid to high range homes getting up into that luxury market, you're seeing higher home values than the peak of last year for 2022. So what's this say to us? That homes are going to continue to appreciate despite high 6%, low 7% interest rates. These raise in interest rates haven't stopped the housing market and appreciation, and they're not going to because of lack of supply. And this supply problem is a 5 to 7 year problem minimum, in my opinion. So what does this mean to you? This means if you're out looking for a home, continue to press on, continue to remain diligent on your search, because when rates drop, which we think will happen between March and June of next year, every election year is the lowest interest rate cycle, typically in a 4-year period. 2020, 2016, 2012, look back, they're the lowest in the 4-year period or near the lowest in almost every election year. We believe that will happen this year as well. They're not going to be rates of 2021, but they will come back down. So what will happen when interest rates drop? There'll be more buyers that enter into the market, driving these prices up higher. So marry the home, date the interest rate, divorce the rent, refinance next year when rates come down. It will be at lower prices, in my opinion, than we'll look at next year. If we can help you get under contract, please give us a call, 312-731-4939.